If you own more than 50 ounces of silver, your exit strategy just changed. Not partially, not temporarily, but permanently. What happened at 8:30 this morning, when CPI data printed below consensus and silver rallied instead of falling, rewrote the rules for how and when you should sell your metal to you. The old exit strategy that most stackers have been using for years is now mathematically obsolete. I'm going to show you exactly why, with specific price targets, specific percentage allocations, and specific trigger levels based on data that did not exist before today's CPI print. If you own 50 ounces or more and do not adjust your exit framework after watching this, you're leaving a minimum of $30,000 to $60,000 on the table over the next 12 months. Let me start by defining what the old exit strategy looked like, because most stackers are still using it without realizing it is broken. The old strategy was simple. Buy silver at low prices, hold until it reaches a target price, usually $100 or some other round number, then sell everything or a large percentage at that target. The old strategy assumed that silver moves in a single impulse wave up and then crashes back down, and that you need to sell before the crash. That assumption was based on two historical precedents. 1980, when silver went from $6 to $50 and crashed back to $5 within 18 months. And 2011, when silver went from $18 to $49 and crashed back to $14 within 4 years. Both examples involved a single parabolic spike, followed by a catastrophic collapse. The old exit strategy says, sell the spike because the collapse is coming. Today's CPI data destroyed the foundation of that strategy. The old strategy assumes the silver rally is driven by a single catalyst. In 1980, the catalyst was the Hunt brothers cornering the market. When the rules changed, the catalyst disappeared and price collapsed. In 2011, the catalyst was quantitative easing. When the Fed tapered, the catalyst disappeared and price collapsed. Single catalyst rallies produce single spike patterns. When the catalyst is removed, the rally ends. The 2025-2026 silver rally is not driven by a single catalyst. It is driven by 11 simultaneous catalysts. And today's CPI data just added a 12th. Here they are. First, a structural supply deficit of 142 million ounces annually for the 6th consecutive year. Second, COMEX registered inventory depletion to 80 million ounces, declining at 1.2 to 1.7 million ounces per day. Third, Chinese export restrictions reclassifying silver as a strategic material. Fourth, Mexican production collapse from cartel violence. Fifth, refining chain breakdown from nitric acid shortages and lease rate spikes. Sixth, military consumption permanently destroying silver in combat. Seventh, solar demand inelasticity at 194 million ounces annually. Eighth, AI data center demand acceleration. Ninth, the Strait of Hormuz closure driving oil above $115. 10th, gold-silver ratio compression from 65 to 57.8. 11th, Shanghai physical premiums at $15 to $16 over COMEX. And 12th, the new catalyst from today, Fed rate cut probability jumping to 41% for June on soft CPI, creating dollar weakness tailwinds. For silver to crash like 1980 or 2011, all 12 catalysts must reverse simultaneously. The deficit must become a surplus. COMEX inventory must rebuild. China must reopen exports. Mexican cartels must stop. Nitric acid must become available. The war must end. Solar demand must collapse. AI buildout must stop. Oil must return to $70. The ratio must expand. Shanghai premiums must disappear. And the Fed must raise rates aggressively. All 12 at the same time. The probability of that occurring is effectively zero within the 2026 timeline. This means silver is not going to produce a single spike pattern. It is going to produce a staircase pattern, a series of higher highs and higher lows with consolidation phases between each step. Each consolidation shakes out weak hands, and each step higher is driven by whichever catalyst is most active at that moment. The January spike to $121 was driven by speculative momentum. It crashed because the CME raised margins and speculators were purged, but the 11 non-speculative catalysts remained intact. Price found a floor at $63.90, rebuilt to $91, and is now climbing the next step. The next correction will be driven by whatever paper market mechanism is deployed next, but the floor of that correction will be higher than $63.90 because the physical shortage has deepened since February. The staircase goes up. Your exit strategy must match the staircase pattern, not the spike pattern. A spike pattern exit is binary, sell everything at the target. A staircase pattern exit is graduated, sell portions at each step and hold a core position through the entire staircase because you do not know how many steps remain. Selling too early leaves the largest gains on the table. Here is the specific framework for holders of 50 ounces or more, broken into 4 tiers based on position size, because the optimal strategy changes with how many ounces you hold. Tier 1 is 50 to 100 ounces. At current prices of $91, your total position value is between $4,500 and $9,100. This is meaningful but not life-changing capital. Your exit strategy should prioritize capturing structural upside while protecting against the next paper market attack. Sell 0% at current levels. $91 is not an exit zone. It is the beginning of the staircase step that targets $100 to $110. Sell 20% when silver closes above $105 for 3 consecutive trading days. 3 consecutive closes eliminates the risk of selling on a single day spike that reverses. That is 15 ounces at $105, which equals 1,375, recovering a significant portion of your original cost basis if you bought below $40. Sell another 20% when silver closes above $130 for 3 consecutive days. That is the Citigroup and Bank of America moderate target zone, and 15 ounces at $130 equals 1,950. Hold the remaining 60% as your core position through the $200 level and beyond. The structural deficit, Chinese export lock, and industrial demand inelasticity support prices above $150 for the remainder of this decade. Your 60% core at $200 is worth $9,000 on 45 ounces. That is your generational wealth component, and you do not sell it for short-term profit. Tier 2 is 100 to 500 ounces. Your position value at this range is $9,100 to $45,500, which is significant capital requiring more sophisticated exit management. Sell 10% when silver closes above $100 for 5 consecutive days. 5 days above $100 confirms the psychological resistance has been absorbed. On a 300-ounce position, that is 30 ounces at $100 or $3,000, and the purpose is to recover your original investment capital and create a risk-free position on the remaining ounces. Sell 15% when silver closes above $120 for 3 consecutive days. 45 ounces at $120 equals $5,400, extracting profit from the momentum phase. Sell another 15% when silver closes above $150 on any single daily close. At $150, the market has entered the parabolic acceleration zone where volatility increases dramatically, and 45 ounces at $150 equals $6,750, reducing risk before the highest volatility phase. Hold the remaining 60% through $200 to $300 and potentially toward the Bank of America $300 target. Your 60% core of 180 ounces at $309 equals $55,620, transforming a $9,000 initial position into a $55,000 outcome on the core alone, plus $14,000 to $15,000 already extracted at lower levels. Total outcome, approximately $70,000 from a $9,000 starting position. Tier 3 is 500 to 2,000 ounces. Your position value is $45,000 to $182,000. This is portfolio-defining capital. Your exit strategy must balance wealth extraction with tax optimization and physical logistics. Sell 5% at $100, which is 25 to 100 ounces. Many stackers have never actually sold physical silver, and the first sale teaches you the mechanics, the premiums, shipping, and tax implications. Do it at $100 with a small tranche, so you understand the process before you need to execute under pressure at higher prices. Sell 10% at $125 or $50 to 200 ounces. On a 500-ounce position, this is $6,250, and on a 2,000-ounce position, it is $25,000, enough to fund your next 12 months of living expenses if needed, creating financial independence from the silver position. Sell 10% at $160 to capture the momentum peak of the current staircase step. If silver reaches $160, the daily RSI will likely be above 75, indicating overbought conditions. A correction of 15 to 20% typically follows. So selling into overbought conditions and rebuying the correction is the optimal execution for large position holders. Sell 5% at $200 as trophy profit. $200 silver will be headline news, and the emotional pressure to sell everything at that level will be overwhelming. Selling just 5% satisfies the psychological need to take profit at a milestone while preserving the 95% that captures the structural repricing. Hold the remaining 70% through the full cycle. 70% of 1,000 ounces at $309 is $260,300, life-changing capital from a position that may have cost $30,000 to $50,000 to accumulate. The staircase exit preserved 70% of your position for the final steps, while extracting enough capital along the way to eliminate financial stress and fund the patience required to hold through volatility. Tier 4 is 2,000 plus ounces. At this level, your position exceeds $182,000 at current prices. This is wealth preservation capital. The framework is the same as Tier 3 with one critical addition. At this position size, consult a tax advisor about the timing of sales relative to capital gains brackets. In the United States, long-term capital gains on precious metals are taxed at the collectibles rate of 28% for federal, while short-term gains are taxed as ordinary income. The difference between 28% and 37% on a six-figure gain is tens of thousands of dollars. If you have held your silver for more than 1 year, every sale qualifies for the lower rate. And if you bought during the 2020 to 2024 accumulation period, you're already past the 1-year threshold. Do not let tax ignorance erode your gains. Now let me explain specifically why today's CPI data altered these exit targets upward from where they would have been set last week. Before today, the market treated silver as an inflation hedge. Inflation up, silver up, inflation down, silver down. That relationship meant a successful Fed campaign to bring inflation below 3% would remove the inflation catalyst and potentially trigger a correction similar to 2011. Under the old framework, exit targets would have started at $95, not $100, because the risk of inflation normalization was a realistic threat to the rally. Today, silver rallied 3% on a below consensus CPI print. The market permanently decoupled silver from the inflation correlation. Silver is no longer trading as an inflation hedge. It is trading as a rate cut beneficiary and a physical shortage asset simultaneously. Lower inflation means rate cuts, which means dollar weakness, which means silver up. Higher inflation means hedging demand, which means silver up. The old framework had a scenario where silver went down. The new framework has no such scenario unless all 12 catalysts reverse simultaneously. That elimination of the bearish CPI scenario raises every exit target by approximately 15 to 20%, because the probability adjusted expected value of each ounce increased when the downside scenario was removed. An ounce of silver that could go to $100 or could go to $70 has a different expected value than an ounce that can go to $100 or can go to $85. The floor rose, the ceiling stayed the same, and the expected value increased. The COMEX inventory data reinforces the raised targets, with 80.22 million ounces registered and declining at 1.2 million per day. By Friday, the registered base drops to approximately 77 million. By the FOMC meeting on March 18th, it drops to approximately 75 million. March delivery demand at 55.1 million ounces represents 71% of Friday's projected registered inventory. The coverage ratio is approaching 1:1. When coverage hits 1:1, the exchange must either default, raise prices dramatically, or force cash settlement. All three outcomes are bullish for physical silver holders because they confirm that the paper pricing mechanism has failed and physical metal commands a premium determined by real supply and demand, not leveraged paper contracts. The Shanghai premium at $15 confirms that the physical market already values silver above $100. Chinese industrial buyers are paying $16 today. When COMEX price converges with Shanghai price, your exit targets at $100, $120, and $150 become the minimum, not the maximum. The gold-silver ratio at 57.8:1 supports the staircase thesis. The ratio compressed from 65 to 58 in just 3 weeks, and the velocity of compression is accelerating. At 50.1, silver reaches $103 from current gold prices. At 45.1, silver reaches $114. At 40.1, silver reaches $129. At 32.1, the 2011 extreme, silver reaches $161. The ratio is never compressed from 65 to 32 without overshooting to the downside, and if it overshoots to 25.1, silver reaches $206 at current gold prices. Tomorrow's PPI data at 8:30 a.m. Eastern provides the next confirmation or acceleration. Hot PPI confirms stagflation, the maximum bullish scenario for silver, because the Fed must choose between fighting inflation or preventing recession, and both choices benefit metals. Soft PPI increases rate cut probability, further strengthening the catalyst that CPI activated today. The staircase takes another step. The bullish abandoned baby pattern on the daily chart confirmed today with a 100% historical hit rate across 6 prior occurrences, projecting $101 to $108 within 5 trading days. That pattern target aligns with the first exit level for Tier 1 and Tier 2 holders. The pattern, the data, and the fundamental catalysts all converge on the same price zone within the same time frame. 50 ounces at $91 is $4,550. At $309, that same 50 ounces is worth $15,350. The difference between selling everything at $100 and holding 60% to $309 is the difference between $670 of profit above cost and $19,900 of profit above cost. The staircase exit captures $9,900. The spike exit captures $670. The exit strategy you choose determines a 14-to-1 difference in outcome. Wednesday's CPI did not just change the silver price. It changed the framework for how you convert your silver position into maximum lifetime wealth. The old rules are dead. The 12-catalyst staircase replaced the single catalyst spike, and your exit strategy must reflect that structural change. Otherwise, you will sell too early at the wrong price for the wrong reason, and watch from the sidelines as the staircase climbs another $200 without you.